Okay, you've probably heard that there are two different types of accounting methods. One is the cash basis of accounting, and the other is the accrual basis of accounting. Now, the cash basis of accounting is the simplest form of accounting to learn, and that is because you only record transactions when you've received cash or you paid cash out. So, for example, you would only recognize revenue when you've actually received cash from customers, and you would only recognize expenses when you've actually paid cash out. Now, although this is the simplest form of accounting and the easiest to learn and probably a good option for small businesses, if you have a business that is more complicated and you need to understand the true performance of that business, such as gross profit or net income, the cash basis of accounting is the worst method to use. And that is why 90% of businesses use the accrual method. Now, the accrual method is different in that you only recognize revenue when you've earned it, and you've only recognized expenses when you've actually incurred it. Now, to understand the true differences between these two methods, I put together a workbook that illustrates these differences. And if you would like a copy of this workbook to follow along and to keep for your own reference, I'll put a link in the description of this video so you can download it and follow along as well. Okay, let's get into this video. I have 3 transactions we're going to take a look at. Each one of these transactions has dates, and these dates are very important in order to know when we record each transaction for each method. So let's take a look at the very first transaction. January 1, we invest $100,000 in our business. Now, under the cash method and the accrual method, this entry would look identical. So, and if you're using this workbook, I'll just show you real quickly. I have a list of the accounts I'm using, and in the account name field, this will connect with that list. Okay, so for the first one, we're going to invest $100,000 of cash into our business. So the first thing that's going to happen is cash is going to go up by $100,000, and the other side of that entry would be a credit to equity, the net value of our business now. Now that will look identical in the accrual method of accounting. Let's look at the second entry. Purchase $50,000 of inventory with our cash. So we'll go ahead and record this now. Now this is the first entry where we'll see a difference. Under a true cash method, this $50,000 will be immediately expensed. So we will record our cost of sales of $50,000, and we will record a decrease in our cash, a credit of $50,000. Now, this is totally different from the accrual method. In the accrual method, we don't expense this until we've incurred it. So what we're going to do is we're going to record this inventory as an asset. So we're actually going to debit this inventory account for $50,000, and we will decrease our cash account for $50,000. Now, both of these entries took place in January. Now let's take a look at the last transaction. On January 20th, you ship $25,000 of inventory to your customer, FOB shipping for $35,000, and you extend the customer credit to pay for it on February 19th. Now, this is where we're going to see a huge difference in the two methods. So in the cash basis of method, we're not going to recognize revenue until we collect it. Well, according to this transaction, we're not going to collect money for this sale until February 19th. However, under the accrual basis of a method, we can actually recognize this method because we have actually earned the revenue. Typically what happens is a customer, in a transaction like this, a customer would send you a purchase order. You would fulfill that purchase order by shipping that order to them. And in this case, we have terms that is FOB shipping point. So from the point that we ship this inventory and that inventory is on its way to our customer, we can now legally recognize this as revenue in the business, and actually at this point we legally are entitled to receive the cash. This is something that would, if our business were to end on January 20th, immediately after we ship this inventory, we would legally be entitled to receive cash for this sale. So let's take a look at the accrual basis of method. So the first thing we'll do is we will record the revenue piece, and I will record. So what we do in the accrual basis is we will record an accounts receivable saying, hey, we've made a sale, we haven't been paid for it, and we need to receive it. So I will go ahead and record the $35,000 sales price. I will also record the revenue of the $35,000, and I will also record the cost of the inventory in this transaction. In the accrual basis of method, we use what's called the matching principle, which is where we match our revenue to the related expenses. So in this case, we shipped $25,000 of inventory. And I will go ahead and record the cost of sale. And I will also record the reduction of inventory. So the cost of sale will be, we know, is $25,000, and the reduction of inventory is $25,000. Now it's February 19th, and we are now receiving cash for this sale. So now, under the cash basis of a method, they will actually recognize their revenue. So their cash will go up by the $35,000, and their revenue will also go up by the $35,000. And then this entry on the accrual method will just look like this. The cash will go up and the account receivable will go down. So the cash will go up by $35,000, and the accounts receivable account now will go down by $35,000. So that's how the entries would be recorded under the two methods. But to truly understand how this affects financial statement presentation, I've taken it one step further. So under the cash basis of method, we purchased that inventory on January 10th, and we recognized the full expense of that inventory of $50,000. So if we generated an income statement for the period of January, which would be January 1 to January 31st, we would have an income statement that shows no revenue and $50,000 of cost, which brings a gross profit of negative $50,000. Well, now in February, if we generated a February income statement from Feb 1 to Feb 28, we would show revenue of $35,000, cost of goods of $0, and a gross profit of $35,000. Now you can see, if you're running a business, it's very difficult to understand your true profit margin. Now let's compare that to the accrual method. And under the accrual method, we're going to recognize the revenue and the cost in the period in which they incurred. So on January 20th, when we shipped that inventory, we were entitled to recognize the revenue. So we recognized the revenue of $35,000. We also recognized the cost we incurred from the exact inventory we sold. We didn't sell all $50,000 of our inventory. We only sold $25,000 of our inventory. So we're only going to recognize $25,000 of our inventory, which matches the related revenue. And now you can see in January, we have a true gross profit of $10,000. So if we're analyzing this business, we can now analyze this business and say, hey, we're doing good. We have a profit margin of $10,000. To take it one step further, I've put down here year-to-date income statement. So if you were to generate a year-to-date income statement, which means January 1 to February 28th, this is what it would look like now on the cash basis of method. We recognized the full $35,000 of cash we received, and we recognized the full $50,000 of inventory we paid for, but we didn't sell all the $50,000, and that is why we're showing a negative gross profit margin of $15,000. Compare that to the accrual method, and you can see our year-to-date financials look exactly the same. And that really is the power of the accrual method, and that is why it's a superior method. If you have any questions you want to ask me, please do so in the comments, or if you have any other ideas for videos or anything you're curious about or you want to learn accounting, also message me, because I'm constantly looking for new ideas to create content. All right, thank you. Bye.